On Wednesday, August 14th, the Dow Jones dropped 800 points, with investors worried about an early recession indicator from the bond market known as the yield curve inversion. The yield curve inversion has many worried that the US economy may be slowing down or even falling into recession. But what is the yield curve inversion? It is when interest rates on long-term bonds drop below the interest rate of short-term bonds. And on Wednesday, the 10-year US Treasury bond dropped to 1.623% yield, and the 2-year US Treasury bond surpassed the 10-year bond at 1.634%. The rise in a bond's interest rate means the demand for that bond is lowering, which is suggesting investors are looking for long-term investments which are safer than short-term investments. And this is one of the signs that investors are trying to conserve more of their money and bracing for a recession. The previous times the yield curve has inverted were in 1978, 1988, 1998, 2000, and 2005. On average, the US has had a recession 22 months after a yield inversion occurred. So a drop in the stock market doesn't necessarily mean the economy will go into a recession at this time, but more so it is just a reaction from investors that are worried about the yield curve inversion. And with most economic indicators, the yield curve inversion might scare off investors when the market will actually continue to grow. On average, after a yield curve inversion, the S&P 500 has risen 21%, so still may be a good time to buy. Former Federal Reserve Chair Janet Yellen said in an interview with CNBC, yield curve inversions have always been a signal of a recession, but the markets may be wrong this time in trusting the yield curve inversion as a recession indicator. She believes that our economy is strong enough to get through the recession despite what the bond market has to say about the 2-year and 10-year yields. Analyst Mohammed El-Iran says the bond market is being distorted by the European Central Bank, which has negative interest rates on their bonds, which is forcing the United States bond rates to be lower. This may be a potential factor into why the inversion occurred. Other analysts point to the slowing economy of European countries, and potentially the trade war with China could also have a negative impact on the bond market. Only time will tell if the yield curve inversion indicated another recession, but if there will be a recession, all signs point to the economy hitting a recession in a year to 2 years if the indications are correct. So in summary, the facts incorrect surrounding the yield curve inversion are: the yield curve isn't an indicator of an imminent recession. The drop in the stock market is most likely just a reaction from investors than the start of a recession. And the facts correct about the yield curve are: this is the first yield curve inversion since 2005, and recessions have occurred on average 22 months after yield curve inversions occurred.